noon. I think I'm going to go ahead and just start since it is noon, and we have a pretty good crowd that have signed up for this course, so we want to make sure they have the full amount of time. My name is Brianna Bentley. I'm with the Macomb Community College Foundation, handling major and planned giving with the foundation, and we've been putting these little workshops on, throughout the past year to the different, people in community, on campus, students, alumni, everyone. So we want to thank everyone for being here today. Just a few housekeeping rules. It's about an hour, so from 12 to 1. Everyone should be muted. You can unmute yourself if you do have questions while the presenter is presenting, or if you're more comfortable, you can put it in the chat box down below. Just so everyone knows, like I said, it will be an hour, so we want to make sure we have enough time to address anything that anyone wants answered. You will also, in the next week or so, from the foundation, from myself, we have something that is called Planning Your Legacy. It's a binder that we put together that's basically a place to keep all your important documents, whether it's, passwords, usernames, beneficiary names, anything you learned today, anything like that. So it's all in one place for you to have and keep for whatever you might need it for. So we have found that we like to send those out via snail mail to everyone that attends these workshops. And if you wanted another one or had any more questions about those, you can always email myself. Everyone's been getting emails from me anyway, so you all have my information. You are also going to be getting this PowerPoint presentation today afterwards. We'll send that to you via email so you have it, and you have the contact info for both of our presenters. I do want to say that this workshop is presented by the foundation at Macomb, as well as Student Life and Leadership, which is a different area of the college that handles, the different activities that students are involved in, whether it's the golf outing fundraisers, anything like that. So we have Jamie and Jen here from that area of the college as well, who we work together to get this out to everyone. So we want to thank them as well. I want to do a brief intro for our presenters. We have Diane Young from Athena Financial. She is the president and owner of that organization. She started her career in finance in New York, and then she became the first female sales manager at that particular firm. She left her office in New York, overlooking Times Square, which I am still jealous of Diane, in 2000, and returned back to Michigan to start her own firm, her own office. She has taught certified financial planning courses at New York University and has given educational workshops to corporations and organizations like Kraft Food Services, the Marriott Corporation. She has her own book, Owning Your Financial Success, a Savvy Woman's Guide to Financial Empowerment, and she writes a monthly column for Community Lifestyles. And then we also have another presenter from the same office. His name is Daniel, and I know we went back and forth. Dan. He goes, Daniel Casey, he goes by Dan. He is the VP at Athena Financial Group, and he began his financial career in Chicago, working for Edward Jones, where he built a successful practice. And then he came to the Athena Financial Group because he wanted to work with families and small businesses and professionals. And Athena offers a full service and full service office there, and it's a fee-only fiduciary firm that does tailor to small businesses and families. So I'm going to stop talking now and hand it over to them so you can get the information that you need. If you have any questions while we're going, just let us know. So with that, I'll hand it over to Diane.
Great, thank you. And just so full disclosure, I'm from Romeo, so I am a homegrown girl here that just went out to New York for about 14 years. So I'm back to my roots. And also full disclosure, my husband does work at Macomb College, so I don't know if that's good or bad. So if you, we still are missing a few people have not answered the poll question. It's confidential. We don't know who's answering what. I'm glad so far that not too many people have been hugely impacted by the pandemic. Most people seem to be a little impacted, so that's not unusual. So Dan, I'm going to ask you to mute. Oh, good, thank you. these speakers do tend to pick up all sorts of ambient noise, and I apologize if you hear a dog whining in mine. I've got a dog over here that's unhappy. So I'm going to end the poll now, and it looks like that, you know, 77% of you have been a little bit impacted by the pandemic, a couple people a lot, and some people are doing better than they were before. So this pandemic has not impacted everyone the same way, but it has probably impacted us all to some degree, whether it's just the restrictions on our lifestyle and that. So we wanted to, our agenda today is we're going to talk about how to assess where you're at. Are you on track? We're going to talk about some of the forgiveness programs that are out there, student loan debt, and then we're going to go into kind of like the positive things like investments, different types of things. This is your workshop. Normally when Dan and I do these in the public, we like to find out what you want to hear about. So please, Dan's going to be monitoring the chat box. So we'd love for you to pop in there now and ask some of the questions that are driving you crazy. I mean, you decided to spend your lunchtime listening to this. There must be something you want to know about. So if you can put in the chat box something you want to know about, we'll make sure that we try to address it. And Dan, and then, you know, you can raise your hand or unmute yourself and interrupt. As part of our thing here for you guys, we're offering you also a copy of my book that I wrote. It's from 2012, but it still has a lot of relevant information in it. I'd gotten a whole couple hundred of them for a big conference I was supposed to do last year. And then of course it got canceled. So now I have a couple hundred of my books sitting around. So I'm just handing them out like candy, like I'm Oprah Winfrey. You get one, you get one. So if you shoot me an email, I will have our assistant send you a copy of our book. So the first thing I like to tell people is, you know, it happens. So don't beat yourself up if you've been negatively impacted by this pandemic. It could be a loss of a job. You could be behind in your rent or your mortgage payments. You may have had to move back home, or your parents may have moved in with you. There's been all sorts of things going on in the last 15 months. And, you know, you could have gotten sick. It could have impacted you that way. So don't beat yourself up. It happens. 10 years ago when the financial crisis happened, we did the same thing where people were feeling really guilty about whatever happened to them. I'm just going to mute. Someone's kind of causing some noise there. All right. So the first step is to develop a plan. Don't put your head in the sand. You know, a lot of times when bad things happen, people just go, I'm just going to ignore it and, you know, watch reality TV instead of my own reality. So we want you to develop a plan of action, figure out what happened, why did you have this problem happen, get the resources you need, and ask for help. Don't go alone. You don't have to do this all by yourself. There's plenty of help out there. So the first step is to figure out where are you now. And Dan is going to drop into the chat box, I hope, the worksheet. And so we have a tool here to help you assess your where you're at right now. Hang on just a second. No matter how many times I prep people to be like, I'm on a call, they still like to come and talk. So we have a net worth calculator. So your net worth is your assets minus your liabilities. And in the spreadsheet, there's these different tabs that you can fill out to help yourself benchmark yourself. And I like to tell the tale of two 40-year-old people, because especially around here, I find in this area, we have a lot of people that are driving fancy cars, they're in big, huge houses, and we think, wow, they're really financially doing great. And then we have other people that live in small homes, and we just assume that maybe they're not doing as great as the other people, when in fact, it could be completely opposite. I live in Warren, and I will say there's probably more millionaire next doors here in Warren than any other place I've lived at. But the guy and the couple on the left, they make, you know, good income. They have a nice fancy house. They drive an expensive car. So on the surface, they look great. And the guy on the right, you know, he's this hardworking guy, doesn't make a lot of money, lives in a more modest home. And sorry, he drives an older car. Dan just told me that he doesn't have that net worth worksheet, so I will have to pop it in before the end of the talk. I'll do that when you're talking on the student loans, Dan. But when we peel under the hood of these two different groups, we realize that the couple on the left have assets of 100,000, which isn't bad, I guess, but their mortgage is 400,000. They have a bunch of credit card debt. And when we add their assets and liabilities up, we come up that their net worth is 150,000, which is only 15% of where we would expect them to be. Conversely, the guy on the right, his net worth is 200,000, which is 66% of where we would expect someone at his age and that to be. Still not quite where we'd want them, but much closer than the couple on the left. And the formula that we use for that, for benchmarking yourself, is called the expected net worth calculation. You take your age, divide it by 10, multiply it by your annual income, and that gives you what your expected net worth should be. If your net worth is higher than that number, then you're on track. If it's lower, then you're off track and you need to start making some adjustments. So, for example, if Susan was making 100,000 and she was 40, we would expect her net worth to be around 400,000. And I just pulled those numbers because I can do the math easy. The next benchmarking number that you should look at is your savings ratio. How much are you setting aside in retirement accounts, savings, investments? Divide that by your gross income, and that will give you your savings ratio. We'd like it to be usually between 10 and 12%. So if you're a young person, if you can just pop 10% into your retirement plan every year, retirement will probably take care of itself. But if you're only putting 3% in, a lot of people will come to us, to Dan and I, and say, well, I'm just doing 3% because that's all my company is matching. That's not the only reason to be putting 3% in your 401k or your 403b. You want to get that number up to 10 to 12% to have a secure retirement. And then the last key benchmark we like to look at is the debt to income ratio, which is where we take your annual debt payments divided by your gross income, multiply it for 100, and that gives you your percentage. It should be less than 36% for overall debt. And Dan, what is the number for mortgage debt?
When you're paying your mortgage, you don't want to be paying more than 25% of your income on your housing, whether that's rent or mortgage.
So you want to make sure that you're keeping your numbers under that. So what do you do if you're not doing this? So first, again, don't panic. Don't put your head in the sand. And don't beat yourself up if you're in your 20s and 30s and these ratios are off, because it's hard when you're just coming out of college or starting your family. You can often make up some of this later on in life, but you don't want to, the earlier you can catch it, the better. So I'm going to be turning it over now to Dan to talk about student loan forgiveness, because I know a few people are about this. I want to share, can you see the Yahoo story that I pulled up? Okay, so this just came up today and I thought, wow, this is pretty amazing. So I'm sure most of you are aware. Oh, Bree, can you put the poll into play about the student loans? Or do I have to do that?
Yep, let me go back and see if I can do it. I know I put it in there. I don't know if you have the access to the polls.
Yeah, let me see. Oh, I do. There we go.
Okay,
we're getting good at this. By the end of this pandemic, we'll all be Zoom experts. So just asking how many of you have a student loan so we can, if no one had one, then we wouldn't spend a lot of time on it. But it looks like it's quite a few of you. So we will spend a few minutes on that. And if you don't have one, you probably know someone that does have one. But this article came out today showing how much, if the administration or if Congress manages to pass some kind of student loan relief, there's been talk of anywhere from no relief to $50,000, how much student loan would be wiped out. And if they canceled just even 10,000 of student loan debt, that would free up 36% of those borrowers would have their debt completely really gone. And Dan likes to talk about the velocity of monies, and all those dollars that someone was spending on a $300 a month on a student loan debt now can be paid, go towards buying a new house, paying off credit card debt, all those other things, or saving and investing for the future. So I'm going to turn it over to Dan now to talk about student loan debt.
All right. Thank you so much, Diane. Thank you, everybody, for joining today. Yes, money velocity is a key there. Diane makes a great point. What that means is how fast are dollars moving within the economy. And, you know, if people are able to free up $300 to $600 per month, well, then not just paying off credit card debts and saving for the future, but maybe you spend some at the local restaurant that was hit hard from coronavirus. That maybe you're, you know, going out and you're going to put new tires on your car at the local auto mechanic. So this money begins to be passed around in your local community, and it's better for everyone. So student loan issues are a huge topic, one that I've dealt with and many of my clients have dealt with. Right now they're in forgiveness forbearance, if you will. It's a pretty uncharted waters where they have stopped interest on loans and stopped payments. That runs through September of this year. From that point, we also saw a change in the actual forgiveness. If you are eligible for forgiveness between now and 2025, there is not a tax bill at the end of your forgiveness. In the past, what would happen was whatever loan was forgiven, so say you had $50,000 forgiven on your loans after making 10 or 20 years worth of payments, that debt would then be forgiven, but the $50,000 would be credited to you as income and you would still have to pay income tax on it. They have taken that away at this point. So now what we're looking at is simply continuing to make steady payments and the debt's being cleared. Now, I haven't seen any stories of anybody applying for this or how approvals are going for this. There were issues in the past administration with the person who was in charge of the education department not processing forgiveness properly, and there was a lot of legal battles going on with that. So forgiveness isn't always an answer to your prayers, but now this administration seems to be taking it more seriously. So hopefully they are able to process these things and get them through and forgiven. So one of the things to consider for forgiveness is working for a qualified nonprofit, because that'll cut your forgiveness years down to 10. But we can go through. I'm going to click to the next slide here. I think I can. Maybe Diane has to do that. All right. So currently what we're looking at, we have general forbearance here on the right side of your screen, which is not granted automatically. You have to apply for that. May be granted for no more than 12 months at a time. Typically, people take it when they are just exiting school and looking for a job. Interest still accrues and capitalizes. So what we're looking at, and then the suspended payments don't count towards your student loan forgiveness. Current payments suspension was automatic. It's through September 30th of this year. Interest isn't accruing like we spoke on, and suspended payments count towards that student loan forgiveness or income-driven repayments if all of the qualifications are met. So we're in a good spot right now, but if you are dealing with large student loans, you're probably saying, well, how are we going to get rid of these things? Well, one of the strategies that we typically talk about, especially in times like these, if you are able to, is accruing capital while we have this 0% interest and saving your assets, saving as much cash as possible. And the reason for saving the cash instead of throwing it on the loans, I'm a big fan of having an emergency fund, something that will make you feel comfortable if you were to not be employed for 3 to 6 months, you're able to withstand that with your lifestyle and essential expenses. From there, once you have that in place, accruing extra insurance capital and saving right now while we have the 0% interest period. And then once the interest period is coming up and once we figure out what route this new administration is going to take with the student loans, either putting a lump sum on the loans to take advantage of this 0% interest period and knock down the principal, putting it all on principal if you can, or holding off and seeing if there's going to be some level of forgiveness. If there's some level of forgiveness, maybe that lump sum goes a long way and helps you clear the remainder of the debt, or maybe your debts are entirely cleared from this forgiveness plan, and you're able to then save and invest that. So it's a strategy of almost hoarding your acorns and then being prepared for that opportunity, whether you get to take advantage of paying at the 0% rate and paying the loan down, or accepting the forgiveness and paying the loan down, or just getting forgiven. So we'll click to the next slide here. All right, so those of you who are ineligible for this 0% interest period because you have a private loan or your loan just isn't eligible, consolidation is a great route to go. Now, consolidation does mean that you won't be eligible for those income-based repayment plans or the forgiveness, but it does decrease your interest rate and makes payments more manageable. Now, to find out what's best for you, I put 2 links in the chat here. One is loanbuddy.com and the other is studentaid.gov. And that's a loan simulator. Both of these are great tools to utilize to figure out your student loan status, what the best payment plan for you is, and what the best strategy is for knocking these loans down and eventually clearing them. So make sure you understand that consolidation takes you out of that forgiveness, puts you into low interest, and basically you're saying to yourself, I'm going to pay these off one day. What your strategy is for that payoff should be fairly concrete, and you should stick to it, whether it's a snowball where you pay the smallest amount first and you build momentum up to the biggest loan, or you take it on the avalanche approach where you take the biggest interest or biggest amount, whichever you choose, and you clear the big ones all the way down to just having the little ones remaining. These are 2 options that you can utilize when you do consolidate and decrease your interest rate. Go to the next slide. If they're eligible for the 0% interest rate, we spoke on that. We're going to be looking at, you can see here on the left side of your screen, there's a good list of those that are eligible. And ineligible is those private loans on the right and specific school direct loans. Now, making sure that you're taking advantage of 0% interest is going to be done by, if you have the opportunity, putting a lump sum on that 0% interest once that September 30th date shows up. Now, I have had questions in the past that, Dan, how do I know how much I should put down? Well, a good place to start, and I've had, nothing is set in stone, right? All of this is going to be based off of what your individual budget and income and lifestyle allows for, and what kind of sacrifices you're willing to make to clear your loans. But one of the things I've advised people is to calculate how much they would have paid off if they had been making payments this whole time, and utilizing that as your kind of par or basis to say, hey, I want to try to pay off at least this much, if not more. It doesn't always work for everyone because of their lifestyle and budget and other things going on. But if you have the capital to do so, that's where we'll recommend starting.
And Dan, you would recommend right now that people, if they have the student loans that are covered that could be potentially canceled, that they don't go consolidating right now because that would make them ineligible to be canceled.
Correct. If you feel that you are in federal loan status and this forgiveness may apply to you, I would not recommend consolidating yet, unless you're saying, I have a big lump sum of cash coming and I'm just going to pay it off and forget about it. If this forgiveness comes, be a tax bill. As of now, there's not, but we'll have to see how they all shake things out. But if the forgiveness is coming down, you're better to keep that capital and put it towards your future, or put it into the economy, be able to spend and travel and do things like that. So that's what we hope for. We hope for money velocity in the economy from these student loans. I have clients who are paying $700 to $800 plus a month in student loans, and that's almost a mortgage. So we hope that forgiving these things will aid people in their, capital spending elsewhere.
Thank you.
No problem.
Thanks, Dan. Dan is the man when it comes to student loan debt and that. So if you have questions in that, he can really help you. He helps a lot of people get their lives reorganized from a budget and cash flow. And unfortunately, I could not get that.
I was just going to say, I'll drop my email here in the chat. If anybody has any specific student loan questions or any investing questions, they're free to shoot me an email. I'm happy to set a meeting and help.
Yeah, so I'm sharing that spreadsheet. I could not do it in the chat box, but Bree is going to send it to everyone. This is a spreadsheet that I was mentioning that you can use to calculate your net worth, your savings rate. So they has the tab on here for everything in here. So credit cards, debt, that's the bane of a lot of people's existence, and that just these high interest rates and that. So developing a plan to pay those credit cards down is really, really critical. And understand how much that interest is costing you every year. A lot of times when we do this for people, they'll will add up how much they're spending on interest, and it's thousands of dollars that could be spent on themselves. So, and keep in mind that all the marketers out there in the world, they know how to squeeze the money out of us, right? I can't even go into a Kohl's because I know I'm going to be $200 poorer when I leave the Kohl's, and then they give me Kohl's crack dollars to get me to come back in a week. So they're really good at helping you part with your money. You need to set up walls and systems in place to keep your money to yourselves. I think for some of us that, maybe hit the button that we're actually doing better this year in the sense of with the pandemic, it's mostly because we didn't have anywhere to go eat out, drink, or spend our money. So it probably has told some people who the real problem of their financial life is, and it's, themselves. One of our favorite, we recommend people to monitor your credit. Many times your credit card companies have credit monitoring for you, or you can use creditkarma.com. Make sure that there's something out there that isn't dinging your credit that you had no idea about. And we love this website called dinkytown.net. It's the stupidest name you'll find, but they are the creators of all the different calculators that you see out there. And you can use their calculators for free on their website. And they have all sorts of credit card debt calculators, mortgage debt, auto loans, like should I lease or buy a car? Should I refinance my mortgage? Or how to do what we call, Dan and I have been calling the roll down credit strategy. So oftentimes people come and they'll have 10, 15 different credit cards, right? Because they go into every store and open a credit card and they end up with this big mess. And then learn to be a frugal shopper, avoid Kohl's. And I love going to the thrift stores. So those are great places. Right now, Dan, and if you wouldn't mind dropping into the chat box these links for everyone, but if you are having trouble with your rent, there are ways to, not pay your rent right now, but you do have to know the rules. So make sure that you understand what is out there. I think this is going to be ending soon. They extended it in January, but let's make sure that you stay on top of it, because there could be big evictions coming down the road if people don't know how to handle this. And the same thing with your mortgage. Some mortgages, if they were backed by the government, had different moratoriums than ones that weren't backed by the government. If you're having trouble with your mortgage, don't put your head in the sand. Call your mortgage company, find out what the resources are for you, and attack it head on. Some people are playing the game thinking, oh, I had one of our clients said, I'm just not going to pay it, because she thought it was a moratorium, and her bank, it's like, yeah, you can have 3 months not paying it, but you got to pay that huge lump sum at the end of those 3 months, and she didn't save up the money. So it became a problem. So make sure you really understand those rules. Any questions on student loan debt, or let's check the chat box. All right, thanks, Dan, put those in there. So if anyone has a question on any of this, they want to either put in the chat box or unmute themselves and ask now, that would be great. And then we're going to move on from all the credit and debt stuff. Okay, I don't see any hands up. All right, so let's talk about fun stuff, right? Investing for the future. So I thought I'd cover the 4 basic asset classes to start. They can be broken down into cash, stocks, bonds, and real estate, or a hard asset. So cash is king. Cash is money that's at the bank. You need it for spending, for liquidity, for if you lose your job, but there's no real upside potential of cash. You might not lose anything, but you're certainly not going to grow that asset. So we don't want to have too much in cash, but we want to have enough for emergencies and saving to spend. Stocks are ownership, bonds are loanership. So a stock is when you own part of a company. So if I own shares if I have $10,000 to do something with, and I say, I'm going to buy stock in General Motors, I'm now an owner of General Motors stock. And with that, I get to vote for the board of directors. I get to participate in the profit of the company in the form of a dividend. And I get to participate in either the growth of the company or the decline of the company. And the risk is that if the company goes belly up, I could lose all my investment. And GM's a great example of this because it did go bankrupt during the last financial crisis. And if you had stock prior to that financial crisis and held it to the end, it became worthless. The new GM stock that's trading now is not the same stock. I had a client that found an old certificate from 1995. And she's like, is this worth anything? It's absolutely worthless. Well, it was worth something on eBay because it's very pretty. And she could sell it for about $15 on eBay just for the paper. So stocks are ownership. Bonds are loanership. So maybe I just wanted to lend General Motors my money. So in return for lending my money to them, they return an interest rate to me. So let's say I'm going to lend them money for 10 years and I gave them $10,000 and they're giving me 4%. And if the company, again, goes belly up, I have to get in line with the other creditors and maybe I'll get something. I would get paid off before a stockholder gets paid off. So bonds are loanership, and you can lend your money to companies, governments, municipalities, all sorts of things. And people go, well, bonds are safe, right? Well, yes and no. So governments go bankrupt, municipalities go bankrupt, and companies go bankrupt. So you have to understand the credit worthiness of that. And then bonds are very sensitive to interest rates. So if, again, I have a bond, let's say I bought it for at 4% interest, and I was happy at the time because my bank is paying me nothing, but now interest rates spike up to 10%, and I have to cash my bond in, right, because I need it for something else. Who's going to want to buy my 4% bond when they can go buy a 10% bond? So I would have to discount my bond, and I might not get the full $10,000. So bonds have different risks too. So make sure you understand what you're getting into when you get into it. And of course, real estate is a hard asset. You can buy a home to rent out, has its own sets of risk in that. But if you ever watch the old movie Gone with the Wind, where the old man's like, land's the only thing worth living for, worth dying for, real estate is a hard asset and certainly has a place in some people's portfolios. Any questions on the 4 basic asset classes?
We have a stock question. Delphine asked, what's the process to sign up for miscellaneous companies stock?
To sign up for miscellaneous, so you want to buy a stock? Is that the question? Not sure I'm understanding the question. So if you want to buy some company stock, you can go to a brokerage firm like we clear through TD Ameritrade or E-Trade, open account, you deposit money and say, I want to buy, 100 shares of something. You can go directly to some companies if they participate in a direct, or they call it a dividend reinvestment program, and go directly to that company. You can go on that company's website. Most companies have a tab called For Investors, and it'll tell you how you can buy that company stock directly without a brokerage firm. It's a pain in the butt, but you can do it. So typically, most people like to open a brokerage account, and then they can buy it, do that. Does that answer the question? I hope that answers the question. So the 4 basic asset classes, and then another way to get investments is, you probably have heard the term mutual fund. People come to us and say, I want to buy a mutual fund. Well, a mutual fund is just a way to buy a bucket of a type of investment. So it can own inside that mutual fund bucket. It can own stocks, bonds, whatever, but the prospectus will tell you what the rules of the road are for that particular mutual fund. And they will set up their own investment policy statement. So I remember in the last financial crisis, some 100% stock funds where the client goes, why didn't they go to cash? Well, by rules of their prospectus, they couldn't go to cash. They have to own whatever the rules of that particular mutual fund are. So that's why when they say read the prospectus, they actually do mean to actually read it. But they're usually professionally managed. They're generally diversified, meaning that bucket will have, maybe hundreds, if not thousands of different stocks or bonds. They're liquid in the sense that you can, instead of having to sell out of an entire position of, let's say, Apple stock or whatever, you can call them up and just get $1,000 or $2,000 back, and usually get your money within a couple of days. They only trade at 4 o'clock. So at the end of the day, they add up everything that's inside that bucket, divide it by how many outstanding shares are outstanding, and that's the price of that mutual fund. So you can't trade it through the day. So if at 10 o'clock you see the stock market's plummeting and you put an order in to sell your mutual fund, it will not close out until 4 o'clock. And in that 6 hours, there could have been a huge drastic decline in those underlying investments. And it can present some tax issues. They're not always very tax efficient because when you buy it, you're buying all the capital gains that may have accumulated inside that bucket, whether you participated in the growth or not. So there's different tax issues on mutual funds. Exchange traded funds are a little bit different. They're not professionally managed. They're generally tied to an index. They're usually, because you're not paying a fund manager, cheaper than a mutual fund, but it trades like a stock. You can buy and sell it all day long. You can margin it, which means borrowing against it to use money to do other things, which is a whole nother level of complexity, and where if you follow the GameStop problems or some of the hedge fund problems that were going on, that was all about margin and that. But they're highly liquid. You could sell it, you could buy it at 10 o'clock, sell it at 1 o'clock the same day. Dan, do you have anything you want to add on those two?
No, I think one of the things that is often overlooked just with the mutual funds versus an exchange traded fund, because to most, they look almost identical. It's just a professional manager. One of the things is the expense ratio. So some mutual fund managers are very, very talented at what they do, and they are well worth paying an expense to own and participate in their mutual fund. However, there are some who follow and have similar holdings to an exchange traded fund, and they don't make large shifts in that portfolio. So you're paying them a large expense and you're getting the same returns that you could get for a tenth of the price here with an exchange traded fund. So just something to be aware of as far as these investment opportunities go.
Yeah, we're very fee conscious on these because if a fund doesn't have to work as hard, then you'll make more money long term. All right, and then I threw into this presentation a little bit about IRAs, Roths, 401ks. We often get a lot of questions about that. Again, people say, I want to come in and buy an IRA from you. Well, an IRA, a Roth, or a 401k are just titles. So think of it like a bucket. So I might have an IRA bucket. I might have my 401k or 403b if I work for a nonprofit like Macomb. And then inside that bucket, I can have my mutual funds, exchange traded funds, and all of that, and have an allocation built up inside that bucket. A lot of times people think, well, I want to be diversified, so they go to 10 different banks in town and open the same IRA, buying a CD at 10 different banks, and they're like, I'm diversified. Well, you're not. You just created a bunch of paperwork. So you want to look at it as a form of a bucket. And I added what I call the 4 boxes of taxation, because I thought this is really interesting because, again, think of these IRAs and 403Bs, 401Ks as titles, and then how they're taxed makes a really interesting thing. So the first bucket, and I'll come back to your question on the 403B. So the first bucket is, it's after-tax contributions, right? You got your paycheck and then you have some money left over, and you put it at the bank It's the interest you earn on it is taxed every year. If you take it out and you have a gain on it, it's taxed on the gain, not the principal, but on the gain. So that typical is like bank accounts, CDs, money markets, some bond funds, and some government bonds. The second bucket is after-tax contributions. Again, I got my paycheck, have some money left over, and I want to put into something that's not taxable while it's in the accumulation phase. But if I take money out, the gain on it is taxable. And that could be an annuity, non-deductible IRAs, not money markets, I meant to delete that, and some US savings bonds. Once you start getting into bucket 2, there's some rules and regulations that go along with it that make it a little less liquid. Then box 3 is, oh, I get my pre-tax contribution. So it came off the top of my income, so I wasn't taxed on it. I don't have to pay tax on any of the accumulation growth while it's growing. But when I take it out, it's 100% taxable. And that would be your 403B, 401Ks, deductible IRAs, and other retirement plans. So someone asked the question, should they put as much as possible into their 403B? And of course, we're going to say yes with an asterisk next to it, because we want to make sure that you have money in bucket 1. You basically want to have money in each of these buckets. But bucket 1 is your liquid money, the money that you're going to need to live your lifestyle on and put as a down payment on a house or your emergency fund. Your 403B bucket is for retirement, and there's penalties for taking it out before you're 59 and a half and stuff like that. So you don't want to put so much money in the 403B if you haven't filled up the other buckets. But generally, we love it when people do that because you're reducing your taxes and today, so that it will grow into the future. So, there's reasons to not do that. But we generally, again, if you want to do 10 to 12%, you're great. And then if you're 50 and you're having to make up for not, having some damage throughout the years for whatever reason, you might want to be maxing out to the most. And if you work at Macomb, you also can do a 403B and a 457 together. So some of you can put like $40-some thousand away or $50-some thousand away if you have that kind of discretion. Really lower your taxes and really make up for lost time if you had a rough start in your earlier career. And then the fourth bucket is after-tax contribution. Again, I paid my tax on the money. It's not taxable during accumulation, and it's not taxable upon distribution. And that would be things like municipal bonds, Roth IRAs, 529 plans, and some cash value in life insurance. Again, bucket 4 has a lot more rules and regulations than bucket 1. So is that clear, or did I just confuse everything? What do you think, Dan?
Well, I think it's fairly clear. If anybody has any questions on the specifics, we're happy to address them.
Yeah, that's the thing I don't like about doing these webinars. We're used to doing a crowd where we can see your faces, and if you've fallen asleep or something like that, So how to get started? First, use the spreadsheet we're going to send you to figure out your net worth. Make a list of all the assets that you own. Make a list of all your liabilities, interest rates, things like that. Use the spreadsheet to figure out your expected net worth. And little tweaks can make a lot of difference. So let's say you're only putting 3% in your 403B or 401K now, and you're afraid to go too far out. Well, take it to 5% this year. The next year, 6%, 7%. Little tweaks can make a lot. Paying a little extra on that credit card debt can really make a huge difference, using the roll down strategy to attack it and have fun with it. And the reason I like to track net worth is because sometimes people get so focused on paying down debt or something like that, that they've lost track of how it's impacting their net worth statement. And then I always talk about learning to negotiate. That's in my book. Learning to ask for more money for a raise, or to pay less on a car, to call the credit card company up and try and negotiate your interest rate, or some kind of forbearance programs. All those things can help improve your financial lifestyle. If you decide to work with a professional, some questions to ask them is, are they fiduciaries? How are you compensated? what type of service plan do you have for your clients, and make sure that you understand. Some firms are kind of one and done. They'll promise you the sun, the moon, the stars, and then you never hear from them again. I always tell people, if the advisor does not clearly tell you how they're compensated, if they're very vague, if they're just like, don't worry about it, generally I say run, because they're usually selling very high commission products that are bundled that you won't know exactly where the fees are in that. So our industry has been moving to more of a fiduciary-based firm with a lot more clarity on how compensation works in that. So make sure that you understand that, as well as what kind of service plan they're going to have for you. Like, how many meetings a year are you going to get with them?
Diane, can you briefly explain what a fiduciary is?
Sure. So a fiduciary is someone who has to do what's right for you. So and an analogy I like to use that kind of resonates around here is cars. If I go to a Ford dealership, I fully expect them to sell me a Ford car. If I go to a Chevy dealership, I expect them to sell me a Chevy. I would not expect the Chevy guy to pitch a Ford truck to me. But if I'm a busy executive, I don't have time, and I'm completely car impaired. I really am. Just ask anyone. The only thing I know about my car is it's blue. If I hired someone to go shopping for me, and I said, and this person said, hey, I'm going to do what's best for you. I'll find you the best car and I'll negotiate the best deal for you. And I'm like, great. And they go out, and I find out later that the reason they steered me towards a Ford was because they got a big kickback from the dealership over the Chevy. I'd be very upset. That person was not acting as a fiduciary for me. And the same is true in our industry. If you walk into a branded company, they might be selling you those companies' products because they're getting more commission or more compensation for it, as opposed to doing what's right for you. So a fiduciary holds themselves to a much higher standard of care and has to do what's right for you, not what's right for them. So firms like mine adhere to the fiduciary standard of care, and you can sue us. So you know how they always say, make sure you read the prospectus or read your client contracts and all that. Those are really ways for the companies to cover their butts, basically, so that they can, if you are upset with them, they'll say, oh, well, you signed this form saying that you fully understood the prospectus and everything like that. So the burden of proof is on you at most firms. With the fiduciary firm, the burden of proof is on us to prove that we actually did the right thing for you. So it's a different standard of care.
Right.
All right.
Do we want to jump back and answer Michelle's question? Is it better to save as much as you can in your 403B while you are working?
Well, I thought I addressed that, but again, it goes back to your plan. We generally encourage people to save as much as they can in 403Bs or the retirement plans, because that's coming, generally speaking, off the top of your income. So it's reducing your taxable income. Plus, it's growing tax deferred. So it's in that, it's in this bucket down here. So pre-tax, not taxable during the accumulation phase. It is taxable on the way out. But for most of us, and the biggest thing that I like about retirement plans is it's automatic, right? You get paid every 2 weeks. You put 10% in. You don't see it. If I had to wait to the end of the month till I paid my bills and then tried to pay myself 10%, the chances of me actually writing that check go drastically down. So I usually say as much as you can put into your 403B, the better. Now, do most people here work at Macomb? I don't know if everyone's from Macomb or if they're from outside, but at Macomb, on your 403B and your 457, you do have several choices for different plans. There are some roadblocks of, different things to look out for. So making sure that you're using the right vendor. Dan and I, have an agreement with several of the vendors that we can help our clients with. So we're happy to help you with that. And then someone brought up that we have an HSA option too. So a health savings account's another. I'm sorry, does someone have a question?
Huh?
Nope, gotta mute someone here.
Yeah, what's happening? Yeah, what the heck going on?
My bad.
Willie, hello? There we go. So health savings accounts are great ways to also save some additional dollars. Again, comes off pre-tax, and then you can, use the little debit card they give you to pay for various health expenses that may be not covered by health insurance. But you can also use it as a bucket to save for the future. And what's kind of cool about them that a lot of people don't realize is that you don't have to reimburse yourself the year that you have the expense. So let's say you want to save up a bunch of money and you have a $5,000 orthodontia bill for your kid. You just maybe paid it out of pocket. You can hold on to that receipt until you go to retire and reimburse yourself then. So it's a great way to pull money out tax-free and retirement, in addition to the other things. Of course, you got to remember where you kept the receipt. So if you're not a particularly good record keeper, it doesn't always work, but those are some of the tricks of HSAs. What other questions? Well, we're running out of time here. So we offer everyone here that attends one of our workshops a complimentary 20-minute call, no obligation, no cost. You can email myself or Dan, give us a call, and we're happy to work with you. We'll be emailing this presentation out as well as the spreadsheet. And if you have questions on how to use the spreadsheet, feel free, because I've kind of lumped it together from various sources and happy to walk anyone through it. So any other questions?
I had a brief question. I don't know if you want to touch on it or Dan. I know, we did talk about when you were talking about paying a little bit more on your credit card, or, that kind of thing, of making small adjustments. Can you briefly touch on if someone does have a mortgage, if you pay a little bit, even if it's, $20 a month on top of what your mortgage payment is, how that would be beneficial for you?
Sure. So if you've already, if you've tackled your high interest rate debt, so your mortgage is, generally speaking, going to be one of the lower interest rates of your portfolio of interest rates if you have a bunch of. So if you've tackled all your credit cards debt and have all that high interest debt paid off, then should you pay off your mortgage? That's kind of the question. And we love people, paying down debt. We're not really big into having tons of debt, but I always say to people too, is that it's very difficult to take a bucket of dirt to the grocery store. So if you haven't taken care of all these other pieces first, then you tackle the mortgage. But if you just make one extra principal payment a year, you'll generally knock 7 or 8 years off the life of your loan. So it doesn't take a lot to bring those mortgages down. And if you haven't refinanced your mortgage in the last year and you think you're going to be in that house for more than 2 years, you should look at, I'm just going to pull up the Dinkytown site here. So on Dinkytown, they have all these different calculators here where you can, like, gee, should I pay my mortgage biweekly, or an extra payment on an existing mortgage will show you, exactly how much if you paid an extra $25, how many more years are you shaving off? And you'd be surprised at how quickly you can pay those off. And then what's the other one that I really like on it? The credit card debt one. Snowball or roll down your credit card calculator, can be very motivating to help people. Paying just the extra $25 will save you, in this particular example, $2,400 of interest. And as Dan was talking about, the velocity of money, of getting your money to work for you, is really critical. So if you haven't refinanced your mortgage, go on to Dinkytown, and see if paying the closing costs and everything like that is worth it, if you're going to stay in that house for a few years. because interest rates, I've been saying this for the last 10 years, oh, they'll never be this low again, but they keep going lower. So I think they're almost as low as they're ever going to get, but who knows, maybe they'll go even lower. But, you know, we have clients that are getting 2.5, 2.75% on a mortgage. That's huge. So, and you know what you can do then is get a 15-year mortgage, and you'll see that you're building up, again, equity and watching your net worth statement go bigger, faster. It's awesome.
Great. Thank you.
You're welcome. Any other questions? Well, I'll turn it back over to you, Brianna. Thank you so much for allowing us to come and share some knowledge with you all. It is April Financial Literacy Month, so.
It's true. I want to thank Diane and Dan immensely for all the information today. I think it was a great presentation, a lot of great information. And like Diane said, you're going to get the presentation that you saw today, the spreadsheet that was talked about, and then via mail, I'm going to mail you in the next week or so that binder that will allow you to kind of keep your stuff organized as you start moving forward with this. And it's actually really handy too. I know, you know, you can just take that if you go to Diane or Dan, you can just take your binder with you and have all the information. I know I keep all my presentation information in there as well, and contact info. Also, if you are looking to get that book that Diane did write, I know she mentioned it in the beginning, you can email her and she'll be happy to send that out to you. That book has a lot of great information, and it's not a super, you know, it's a good read. It's an easy read. It's a very
it's an easy read.
Yeah, it's not confusing or anything. It's actually, you know, and very informative. So if we have no more questions today, I'm going to go ahead and we'll end it for the day so people can get back to their day and lunches. But you will receive an email from me shortly with all of the information from today. And then, you know, keep an eye out in the mail for that binder. So again, thank you everyone for joining, taking the time. Thank you, Diane and Dan, for being here today to help us with this. It was a lot of great information, and we look forward to working with you in the future. So thank you so much, everyone, and you know,
thanks everybody.
Thank you, everyone.